Welcome to your ultimate guide for first-time homebuyers and others that may just want a refresher. My name is Sarah and I'll walk you through all the steps from start to finish. The more you know about the home buying process, the more you understand how it works, the more money and time you will save. This guide is meant to provide an overview of the home buying process. At the end of the video, I will address some questions I hear often and give some professional advice. This is the roadmap for home buying process, which we will refer to throughout the video. The overall process from pre-approval to house hunting to closing can take as little as 1 month or as long as years, the average being about 4 months. This depends on many personal factors and how well prepared you are, and you've come to the right place to get ready for your exciting journey by watching this video. These are some financial considerations to bear in mind in the months leading up to your mortgage application. First and foremost, do not take out any type of credit line a few months before applying, and especially not during the process. This includes not only not getting a new credit card, but also not financing things like a car. If you need a new car and a new house at the same time, try to delay the car purchase until after you close on the home. Your home purchase will not influence your car purchase in the same way that your car purchase will influence your home purchase. Second, if possible, avoid transferring large sums of money into your account within 2 months of applying for a loan. That is, don't put a lot of money into the accounts that you will be using for your down payment and closing costs. I'm talking about thousands of dollars here. You should be fine with a couple hundred, but just keep this in mind. Worst case scenario, you will simply be expected to explain where it came from and why. This is because your lender wants to ensure that the money deposited in your account is not a loan from someone that expects the money back. In a general sense, it's also to fight against money laundering. Your lender will most likely consider 60 days before your application. You can transfer funds as long as they've been seasoned, which means they need to be in your account for more than 60 days. Next is income and job stability. Your lender wants to be confident that you are likely to repay your loan. Lenders prefer that the borrower has 2 years of income, and if there was a job change, then they need to be within the same field. It is usually advised not to change jobs within the home buying process. With that said, if you have a signed offer letter, you are going to make the same or more than your previous job, and you're within the same field, then you may be in the clear. But talk with your loan originator. Just don't change career paths right before or during the process. The first thing to think about is your money and how your finances are set up. You want to be in charge of your home buying experience and not let others steer you in an unfavorable direction. So I will lay out all the typical costs you are likely to need to save for in order to be well prepared. It may be difficult to determine how much money you want to spend on the process, but there are some general guidelines to get you started. To begin, determine how much house you can and want to afford. Nobody wants to be house poor, and if you completely exhaust your mortgage allowance, you may become house poor. Only you can set your budget, and you need to figure out how much money you'll spend each month. And how much money will you spend for down payment and closing costs? A good rule of thumb is that your housing payment should not exceed 25% of your take-home pay after taxes. Some programs do allow up to 40% depending on your credit score. The housing payment is going to be made up of the principal, interest, taxes, insurance, and sometimes HOA fees. It all boils down to what monthly payment are you comfortable with. Once you've determined how much you want your monthly payment to be, you can use online calculators to get an estimate of how much house you can afford. The calculators are a super rough estimate, but this is going to give you a starting point. The price of the house is important in determining how much the down payment and closing costs will be. The common misconception is that you must put 20% down on a home. Conventional homes require 3%. FHA requires 3.5%, VA and USDA require no down payment, and there are jumbo loan options that require low down payment as well. Please keep in mind that these options may vary depending on one's credit score. The point is that there are options for almost anyone looking to purchase a primary residence. Now there are closing costs after you've considered your down payment amount. Closing costs are a combination of the costs associated with closing a loan. These include not only lender fees, but also title fees, taxes, county fees, among others. Closing costs may appear to be created arbitrarily in order for someone to make a profit, but they are actually required to close on a home, and there are many moving parts to do so. The total amount of closing costs will be determined by services required, local taxes, and other service providers that you select. Yes, there are services you may shop around for. Is it really worth the time or effort to really save you money? Well, that's going to be entirely up to you. A good rule of thumb is to budget approximately 4% of the purchase price for closing costs. This figure, however, can range from 2 to 6%. I wish I could tell you that these are the only costs associated with purchasing a home, but with such large responsibility comes precautions that will save you headaches in the long run. These are your out-of-pocket expenses, which you must pay separately and are not included in your closing costs. You'll start with an inspection. You'll be able to select your inspection company you want to use. You will almost certainly book this yourself. You will be charged for the appraisal. This is for a third-party company to come out to your house and determine the worth of the home. This is required to fund the loan because lenders will not lend you more than the home is worth. This is because the home is used as collateral if you were to default on your loan. The appraisal is usually set up by your lender but paid for by you. Another out-of-pocket expense is the house survey documentation. This is to indicate the property's boundaries. It is a good idea to set aside about $1,000 for each, the inspection, appraisal, and survey. However, people pay more around $400 depending on your location. Personally, I would rather oversave than come up short later in the process. Before we get into the numbers, there are a few things to keep in mind. When your realtor drafts a contract for you, they usually include a grace period for you to get an inspection. This usually means you have about 5 to 7 days to get an inspection, and if you want to cancel your contract for any reason, you can do so without penalty and get your earnest money back. This may not always be an option, but it's worth checking before you make an offer on a home. Also, keep in mind, because fees such as inspection costs are out of pocket, if you cancel your contract or the house falls through, you will still be out of pocket that money. If you have a lot of contracts and go through this process a lot, this can definitely add up. Moving costs are another out-of-pocket expense to consider when arranging financing and ensuring that you have enough money to get through the process. It's a process. This may seem obvious, but it is all too easy to look at your account and say, oh, I have plenty of money, and then fail to account for moving expenses. Take it from someone who has moved across the country several times. Moving can be expensive. Before we proceed from pre-planning, your FICO credit score is a very important piece to the puzzle. To begin, depending on your lender, you may be able to apply with a FICO score in the low 500s. However, your down payment requirement and interest rate will be high. To get a decent rate and down payment requirement, most people aim for about 620. In the end, the higher the credit score, the better terms and rate you will be offered. It's worth noting that you don't need to overly worry about your credit score. It said, date the rate, marry the house, meaning a rate can always change down the road with a refinance, so don't get too hung up on the initial rate. Surprisingly, depending on factors, a credit score from say 650 to 700 could have a low monthly difference, such as $40. The point is that if you have all your finances in order and your credit score is the only area you would like to improve, it may not be worth waiting months to do so while paying more rent in the meantime. Now that we've examined our financial situation, we can begin the process of purchasing a home. To begin, you will require the services of two key players, a real estate agent and a lender. One finds you the house while the other handles your mortgage. Is it the chicken or the egg that comes first? In this case, you can choose which option you want to go with first. If you choose a local lender first, they may be able to assist you with finding a real estate agent or vice versa. One reason to start with a lender is to determine whether or not you qualify for a mortgage and how much you can afford. One of the first things a realtor wants to know is your price range, so they can start looking at homes that might be a good fit for you. Also, most realtors may not want to take you on house showings until you have your pre-approval. Not getting a pre-approval not only wastes your realtor's time, but also yours. The pre-approval is used to demonstrate how much house you can afford, and the seller's agent will request it when you put in your offer, because this demonstrates that it is a valid offer. You can work with 3 different types of lending institutions. Working with a mortgage loan originator who works at a mortgage broker is an option, a bank or credit union is another option, or you can use an online lender. They will have different rates and costs as well as different business styles, which may determine who you enjoy to work with. You will be ready to get pre-approved once you have decided which type of lender you want to work with. Keep in mind that you are not stuck with the first lender that you send documents to. You may just find that you don't click with them. Some say there are about 45 days in which you can have your credit pulled. However, to be safe, I like to say to stay within the 30-day window. There are a few documents you'll need to get pre-approved: a driver's license, social security card, pay stubs from the last 30 days, the past 60 days of bank statements using the bank that you're going to pull your closing costs and down payment from, the most recent 2 years of W-2s if employed, or the most recent 2 years of tax returns if self-employed. These are among some of the documents that may be required, but other documents may be requested depending on the loan type you qualify for and the pay structure that you receive. But again, this is a good starting point. You will have a better idea of your monthly payments and how much house you can afford once you've been pre-approved. You will want to get a TBD loan estimate, meaning a loan estimate that is based on the area you are looking in, not a specific address since you haven't found a house yet. This will give you a good layout of the fees and breakdown estimate of closing costs. It is worth mentioning that the interest rate on your loan estimate is not locked unless you pay to have it locked. The interest rate becomes automatically locked once you are under contract for a specific property, and it usually only lasts for a certain period of time. Be sure to ask your loan originator if you are unsure how long your rate is locked. Being specific with your loan originator about your financial goals is important. They may present you with the maximum amount of house you can be approved for, which may not be the amount that you want to spend monthly. I find it more effective to work backwards and ask, based on your spending, what monthly payment are you comfortable with? The total house value can then be calculated. Some people stretch their budget to see what they can qualify for, but this can cause problems. Let's say that you're approved for $400,000 and make an offer at that amount. Your loan may fall through. However, it shouldn't if your loan officer planned properly, but things like large spikes in interest rates could reduce the amount you can receive once you put in an offer. This is due to the fact that unless you pay to lock your rate is not locked until you're under contract. A significant increase in interest rate would result in a higher monthly payment for that same $400,000 house, potentially increasing your debt-to-income ratio. As a result, you may no longer be able to qualify for the same amount as time passes. It's always a good idea to have some wiggle room. Not only would you be concerned about your loan falling through, but you might also be setting yourself up for a costly mortgage. If your interest rate is fixed, other factors can cause your monthly payment to rise. Homeowners insurance and taxes are two of the variables. This is likely to increase year after year, so if your absolute maximum you want to spend is $3,000 per month, and these two variables increase after the first year, your budget is now going above and beyond what you may be comfortable with. It is a good idea to budget for this type of increase in your mortgage payments every year. If you have any questions about the numbers presented to you, or you believe they should be different, please contact your loan originator. If you don't feel comfortable asking questions, then maybe it's a sign you need to find a new loan originator. Buying a house is a huge undertaking, and maintaining open lines of communication with your lender and realtor is critical to making the process enjoyable as it should be. Most of the time, it comes down to, do your personalities align? Bad vibes can ruin the whole experience for you. You may believe that you only need your loan originator to approve and put you through underwriting once you are under contract. Choosing an originator who is responsive, responsible, and easy to work with is just as important as choosing a real estate agent. If there are any last-minute details that need to be worked out, you want to ensure your originator will do whatever it takes to close the deal. You want someone who will keep you updated on any changes throughout the process. Let's just assume your originator requires verbal confirmation from your employer in order to approve your loan. You, the borrower, are unaware that they are unable to contact your employer. You have 1 day until closing, and your originator has not notified you of the delay. This is a problem and could have been easily resolved if they had communicated it to you. You would probably have given another point of contact for your workplace, or you could have informed your employer that your originator would be calling. The point here is to choose a loan originator that is forthcoming with information and is responsible. You will need them throughout the process. You'll need a real estate agent now that you've received your pre-approval. The same principles apply here. Check to see if they are responsive and interested in assisting you with the process. You can find real estate agents through referrals or websites like Zillow, or by contacting a local brokerage and asking for help. Do not, under any circumstance, use the seller's agent as your agent. Seller's agent, as the name implies, they do not work for you and will not have your best interests at heart. Your buyer's agent is usually paid by the seller, so you won't have to worry about paying them out of pocket. Once you've decided on a real estate agent, make sure it's the only one you're working with. A short story of how I've seen this become an issue. Someone had an agent and then got another agent to show them a house while their original agent was out of town. This was their dream home and they wanted to close the deal with their original agent. Do not attempt this. If your agent is unable to show you a house, they should have an assistant to help you. The second agent that showed the house may have been entitled to a portion of the sale commission. This can get complicated. Keep your original agent unless you no longer want to work with them for whatever reason. Now comes the exciting part, house hunting. Again, first rule is to not look beyond your means. It's not fun to get excited about something you're not eligible for. It can also be beneficial to have a list of things that you must have in your house and things you would like to have in your house. It's easy to get all caught up in the process and overlook an important element of what you must have in your house. Excitement can blind people to what they require in their daily lives. The process of submitting an offer can be quite quick. Depending on the competitiveness of the market, you may have to decide whether or not you want to make an offer the same day you view the house. If you have already a solid list of must-haves, you'll know right away if this is the right decision and you won't have to sit on it for a couple days. This could cause you to miss out on your dream home. Before you drag your realtor all around looking at houses, consider the following. Take the time to look at websites such as Zillow to get a sense of what you like and dislike. I can tell you if a house is a no-go from the first 2 pictures. It is critical to know what you like so that you do not waste your time looking at 50 houses. When you find the ideal home, you will make an offer on it. Simply tell your realtor that this is the one, and they will prepare an offer for you and send it in to the seller's agent. If your offer is accepted, it will become a legally binding contract, so take this seriously. Your realtor can advise on how to make your offer more competitive and appealing to the seller. They may even be able to obtain information on previously submitted offers. This can help you determine what offer amount will put you ahead of the competition. In addition, an appraisal gap can help you make your offer more competitive. The appraisal gap is the extra money you offer in addition to the overall purchase price. Your lender will only lend you up until the appraised value. So if you offer $400,000 and the appraisal comes in at $380, you will only get financing up until $380,000, even if you are approved for the $400,000. This is due to the fact that the house serves as collateral if you were to default on your loan. Let's break it down because all these numbers can get overwhelming. If you add a $10,000 appraisal gap, you're telling the seller that if the appraisal comes in lower than the offer price, you'll have to pay up to the $10,000 out of pocket. Even if the home appraises for $20,000 less than the offer price, you will only be required to pay the $10,000. If the appraisal comes in at $398,000, you would then only need to pay $2,000 to make up the difference between $400,000 and $398,000, rather than the full $10,000 you promised. And if the home was priced correctly and the appraisal comes in above your offer, congratulations, you have instant equity and don't have to pay any appraisal gap. To be clear, I am not advocating that you pay more than the house is worth. However, depending on your market, this could be the make or break moment to getting your offer accepted. The way I look at it is if you need to move soon and there aren't many homes that fit your criteria, then make your offer competitive. You may end up paying more in rent over the next year that does not contribute to any equity than what you would have likely offered as an appraisal gap. And if everything goes well, you won't even have to pay the appraisal gap. And guess what? You have your dream house. Another way to ensure you don't get outbid is to have an escalation clause in your offer. This is another item to discuss with your realtor if you are in a competitive market and keep getting outbid. Usually, once all the offers are in, the seller chooses which one to accept. They don't usually let everyone know the highest offer in an attempt to get a counter. So, a way to stay ahead of this is an escalation clause. This means you put in an offer, and if someone offers higher, then your clause will state that you will pay X amount above the competing offers until you reach your maximum price you are interested in offering. Your realtor should know what other buyers in your market are doing to get houses. So if there are any other offers on the house you want, they will be able to advise you on how to stand out. It all comes down to finding a realtor you can trust who is looking out for your best interest. After your offer is accepted, you will be given a short period of time to send in your earnest money. This payment will go toward future costs if you close on the house. This money is not a random payment. It is intended to demonstrate your good faith in your offer. On your closing disclosure, the amount you pay in earnest money will be deducted from your cash to close amount. This means that the earnest money will be applied to your closing costs. Within 3 days of putting an offer in, you will receive a loan estimate with updated information that pertains to the specific property. This will have a more accurate estimate, but remember, it's just that, an estimate. The main number to take note of is your cash to close. This will be what you are required to pay before closing on the house. The closing cost fees I previously mentioned will be outlined in this document. There are so many elements to a loan estimate that a whole other video needs to be made to explain them in depth. Next order of business is to get your inspection scheduled as soon as possible. Remember the week grace period for an inspection? You will want to set this up as soon as possible. You can Google inspection companies and read reviews, or your realtor might have some to recommend. It should be noted that the inspectors are required to write an entire report based on the property. They take photographs and documentations to do so. This may take some time, so you may not get your documents that same day. When you get your inspection results, don't panic if there seems to be 1,000 different things to fix. Keep an eye out for large ticket items such as a long-term leak that could lead to larger rotting issues, termites, or a roof replacement. If you do discover major issues during the inspection, now is the time to speak with your realtor and see what items they recommend negotiating. Sometimes it makes sense to request the items be repaired prior to closing, and other times it makes more sense to request a seller's credit to reduce your closing costs. Your realtor is there to represent you and guide you through the negotiations. Okay, you've decided to go ahead with the purchase of this house. Your pre-approval is now being processed through the underwriting process. This procedure is required for finalizing all the numbers for your closing and ensuring that you, the borrower, will repay your loan. Your lender is lending you hundreds of thousands of dollars, and they want to know if, based on all the information they have, you are likely to repay your loan within the time frame you agreed to. The underwriter is not attempting to increase your anxiety or offend you in any way. It is their responsibility to conduct due diligence to ensure that all information gathered during the pre-approval process is still correct. It is not uncommon for the underwriter to request additional documentation or to have certain discoveries explained. That being said, if your loan originator submitted all your information and checked your credit, you should be fine. It's just worth noting that after further investigation, issues from the past may be called into question. This is not to mean your loan is not going to close. Simply submit any requests they make and have faith in the process. It may feel like you've had everything squared away, and now that you're being questioned, your loan is falling through, but this is not the case. I'm here to tell you that this is normal, and do not worry. When you say, "Congratulations, your loan has been approved," it doesn't mean you're in the clear to close. If it is a conditional approval, then you will have to submit requested documents to get the official approval. You are not clear to close until you are explicitly told so. Underwriting can take several weeks. Typically, your closing date will be set 1 month after your offer was accepted. There are numerous reasons why this may not be the exact time frame, but it is a good starting point. Shortly after your inspection, you're going to want to look at homeowners insurance. Don't put this off. Depending on the state, this could be a piece of cake, but in states like Florida, it can be a bit more difficult. Florida is experiencing a homeowners insurance crisis, and many of the major insurance companies don't provide services in the state. Long story short, using Florida as an example, insurance companies have been losing money on things like replacing roofs due to hurricanes. The point is, don't put off getting quotes because it's a good idea to get about 3 quotes to ensure you're not getting ripped off. In Florida, for example, some insurance policies can cost up to $13,000 per year, while others for the same property can cost up to $4,000. This is still high, but it is significantly lower than the first quote. These figures obviously depend on a variety of factors about your home, such as location, age, and value. Because your loan will most likely have an escrow account, you will need to shop for homeowners insurance sooner rather than later. Your lender will need to know how much your homeowner's insurance will be and who it's with so they can add this to your closing disclosure. Your lender will have an account for you known as your escrow account, where they collect your homeowner's insurance, taxes, and sometimes HOA to pay them in advance for you. If you have an escrow account, approximately 12 months of these fees will be collected in advance as part of your closing costs. This is a buffer amount, and a portion of your monthly payment will automatically be deposited into your escrow account. These fees were only estimated on your initial loan estimate, which is why your monthly payments may differ from what you were initially told. It depends on the insurance you select. At this point, your lender is still in underwriting and will order an appraisal while you keep working on that homeowner's insurance. As a reminder, this is one of your out-of-pocket expenses. You pay for it after your lender orders it. Because the appraisal is performed by a third party, there is no bias in the opinion of the home's value. They calculate the value differently depending on the type of home. The most common method is to perform an in-person inspection using recent sales of similar properties and specific property characteristics to determine the value. The exact homes used for comparison will be listed on your appraisal report, so you can reflect back to that. They use other appraisal techniques if your home is a new build or has extremely unique architecture, such as a cave house. If you believe your appraisal is incorrect, you may request a new appraisal to be performed at your expense. This has occurred before when two condos in the same complex were for sale at the same time. Each condo had a different appraiser, and one came in pretty low. In this case, they requested a second appraisal to be done because they were nearly identical and both on the market at the same time. Your appraisal is not always higher than the offered amount. This is where your appraisal gap may come into play. Your lender will only fund your loan up until the lesser amount of the appraisal or the offered amount. If your appraisal came in lower than the offer price, you must notify your realtor. They can walk you through the process of either exercising your appraisal gap if you have one, or hopefully lower the price so that the loan will cover the entire amount. Well, you guessed it, you are still in the underwriting stage. This part may appear to take an eternity. You will receive a closing disclosure, also known as a CD, once your lender is finished. The layout of the CD will be the same as your loan estimate, but with finalized numbers. If you're curious about which numbers have changed and why, compare your CD to your original loan estimate. As previously stated, the amounts usually fluctuate due to factors such as the type of homeowner's insurance you may have selected. If any other numbers have changed and you would like to know why, please contact your loan originator. You will be required to sign it. Some people look at it and take their time to sign it. Sign it once you are comfortable with the numbers, which you should be pretty comfortable with at this point if your loan originator has explained them to you. This is important because federal law requires that the initial CD be signed 3 business days before closing. That is, if you receive the CD 3 days before closing, which is the minimum amount of time the lender is allowed to deliver it, and keep it until the next day. With only 2 days until your closing date and no signed CD, your closing date will likely be pushed back. Once you have received your final cash to close amount, your lender will inform you of how to send the money to your title company, whether it be certified check or a wire. It's finally closing day after all your hard work. You will walk through the house before closing. This is known as your walkthrough. This is sometimes scheduled for the day before, but it is best to do it the morning of closing. There have been horror stories about people doing a walkthrough the day before and finding everything looked fine. Then they closed on the house, got the keys, moved in, only to discover that the appliances had gone missing. The walkthrough is intended to ensure that everything specified in the contract is present in the home. Now you are ready to sign once you've completed your walkthrough. This is done in various ways depending on where you live. You might go into the realtor's office and find yourself sitting at a table with just your realtor and a representative from the title company. Before you sign it, the representative will walk you through each of the documents. This procedure can take about 30 to 40 minutes. Don't feel obligated to sign it right away. You can review or ask questions. If your loan originator was diligent, you should have a pretty good understanding of the documents you're about to sign. Your new house keys should be handed to you and you are ready to move in, unless otherwise negotiated for a different move-in window with your seller. Congratulations, you've moved in at this point and you're a homeowner. This would not be an ultimate home buying guide without some professional advice and insight. Before beginning the process, it is critical to understand what factors may influence your loan approval and amount. What loan option should I apply for? And do I want to apply for an FHA loan? Is a common question I see on social media and online forums. When speaking with a loan originator, keep an open mind. Sometimes people have tunnel vision on what loan or program they think they want. but it's our job to provide professional advice on what best aligns with your financial goals. It's ideal to work with a loan originator who asks questions up front, such as, are you more interested in saving money now or in the long run? In other words, are you looking for down payment assistance, or do you want to put money down to get a lower monthly payment? How long do you intend to stay in the house? Questions like these indicate that your loan originator is weighing options to determine which loan is best for your financial goals. You don't have to try and figure out what loan is best for you. Your lender should compare them and explain the different options thoroughly. They are licensed and trained in mortgages, so they can advise on what may be in your best interest. Again, it comes down to selecting a loan originator that you trust. It's also worth noting that some people only consider interest rates when deciding on a lender. Other factors can cause your monthly payment to rise or fall. A loan with a higher interest rate may result in a lower monthly payment than one with a lower interest rate. If the mortgage with a higher interest rate has lower mortgage insurance payments than the one with the lower interest rate, your payment may be lower with a higher interest rate. You can always refinance in the future to lower your rate, and considering the big picture can save you money rather than dismissing an option because of a small rate difference. When planning your finances for a home purchase, people are curious about when their first mortgage payment will be. It depends on the time of month that you close. However, if you close in the first week of the month, your first mortgage payment will be 2 months later. An example, if you close early January, your first payment will be in March. The last item I want to mention in this video is a big one, so listen up. Once you close on your home, you may receive letters in the mail about your mortgage. If any of the letters are attempting to have you sign up to pay your mortgage off faster or anything that has to do with changing the structure of your mortgage, don't do it without talking to your lender. I say this because there are many scams out there that will send you letters that appear to be from your lender directly, but they're not. Always speak with your lender before doing anything different with your payments and mortgage in general. This is your ultimate guide to the home buying process. Hopefully you have a comprehensive overview of what to expect and how to get started. If you are interested in getting pre-approved and looking for a home, I'm your local friend in mortgages. Down below, you'll see a link to sign up for a meeting with me if you're interested. See you next time for more in-depth information about mortgages and the home buying process.